Dan, good morning to you. Please, you could be with us. What you're saying essentially is that things could get a lot uglier next year, especially in enterprise software, and even with the hyperscalers like Amazon, Google, Microsoft.
Absolutely, because if you think about where we were during COVID, every business had to get online. So everybody needed to buy software, cloud computing resources to make sure their business survived. Now you fast forward 3 years and everybody's going out, we're going on vacation, etc. And the sale of goods is slowing down as people consume more services. And so now you need less cloud computing resources. You're firing people, so you need less consumption-based software. And you saw that with Salesforce, right? When they reported, they took down for the next quarter their current remaining performance obligation, which is a fancy way of saying, what's the momentum of your business? People were thinking that would grow 11% in their upcoming quarter. They guided to 7%. And they're the big bellwether in the space. So I think as companies set their budgets for next year, they go, well, we're going to have a lot less employees than we thought. We need less enterprise software. We need less cloud computing resources, et cetera. Next year is when you see the issues in enterprise, when this 2022 has really been about slowdown in consumer goods, things like at Amazon or Zoom or Peloton, et cetera.
Yeah, so investors have been trying to price that in, and you've seen certainly those multiples come down. However, you're thinking it could be worse than even the market's anticipating right now. AWS, for example, you could see the growth rate coming into the high teens. Is that right?
Yeah, I mean, if you think about what they had to say, right? Amazon, everybody thinks of it as a retail company because we all get packages every day from them. But if you look at what really drives the profits in their business, I think they generated like $5 billion from Amazon Web Services last quarter in operating income. The entire company did $2.5 billion. So it's really Amazon Web Services that drives the multiple for that company. And you saw them miss the quarter when they reported. And then they said exiting the quarter, revenues were growing at 25% in Amazon Web Services. And I think you're going to see that number get into the teens next year. By the way, that mid 20% growth rate's the slowest since 2014. So you're going to see things continue to come in there, and I think that's the issue. These are consumption-based models, and consumption is slowing down for internet-based services.
Hey, Dan, just to get you on the broader markets, it's almost become comical how consensus this year-end strength is, whether it's positioning or buybacks. It doesn't sound like you have too much to quibble with it, though.
No, I mean, if you look at our tweets going back to October, we've been calling for a year-end rally. We're getting it. We think we go through some digestion this week. But I think you're going to see a rally between here and Christmas because, you do have a lot of positives in the sense that you've got the fear of missing out now kicking in. People are underexposed. China finally, after the, social unrest they had a week ago, is getting off this COVID zero policy, which is good for end demand. And so I think you're going to see this rally. The problem is you're going to get to the end of this year, and then you're going to have to report numbers again. And you're going to enter a pre-announcement period, and I think that's when things get ugly. So we still believe that after you get sort of this next bear market rally kind of running its last gasp, that you go and retest or break to new lows when you get into 2023, because now all those Fed rate hikes that you've had starting since March, they now are starting to affect demand and slowing things down. And so our view is no different, that this is just another bear market rally. But, trying to take advantage of that, and things are going pretty well.